Hey everybody, in this short video I'm going to be going over a quick example of how premiums work. Right now the stock SMCI has an extremely high implied volatility, and so what that means is the implied move, or the move that the market is expecting, is very large. The options on this stock are also very high due to the high implied volatility. Basically, this stock is moving over 100 points per day, oftentimes, right? Just last week, we had a $240 move in a single day. And so, because of that, the out-of-the-money options, the in-the-money options, all of the options are a lot more expensive than they would normally be. Options are priced based on the expected move, how much the market makers expect the stock to move. And so when a stock is having a period of heightened volatility, the options on that stock are going to be quite expensive. If the stock goes sideways after a extensive move, then the options, both the calls and the puts, in the money, out the money, at the money, all of them are going to lose a ton of value. For example, this week we have the 1100 calls at $1,300 a contract, right? That's a 240 point move that they're saying costs $1,300 per contract. If the volatility wasn't there and, this thing was just going sideways, that move would be much more unlikely. But since it's been moving so much per day, the market makers are saying, well, a move over 1100 isn't that unlikely, and so if you want to get into a position of it going that high, an option, you're going to pay $1,300 a contract. But if SMCI goes up to, let's say, 900 and then goes back down to 860 and closes at 860 on Monday, then the 1100 calls, they're going to go down substantially. The theta here is only 4, but the thing that is not being factored in is the vega, which is the change in option price per 1% change in implied volatility. Now, the implied volatility here is 167%. If that goes down, then so does the value of that option. And so if, for example, Super Micro Computer opens at 850 on Tuesday, right? So Monday it just goes flat basically, and then Tuesday it opens flat as well. I'd say those options might be down, 30 to 50%, maybe even more. So, you're risking more than just one theta, which is the value that the option will lose after one day. What I'm getting at here is the options prices for a stock that's this volatile are extremely high, and without a move of over 100 points in a day, I'd say you're not going to get that gain you think you're going to get. So the stock has to make a very large move in order for these options with extremely high implied volatility to move. Now, I'm not saying that the stock can't do it. It definitely can. I'm just saying that in order to make a good return on options on a stock with high implied volatility, you have to get a larger move than expected. If SMCI just moves sideways all week between 950 and 850, then come Thursday, those 1100 calls are going to be like maybe $2 or so, from the 13. When you have options this expensive, it's really hard to get a good trade, and it's really hard to actually do well, because even if the stock starts moving your way, if it doesn't move your way fast enough, these options are actually going to lose value. You definitely have to take that into account when you're making trades on stocks with high implied volatility. And so what I prefer to do when I have a stock that has very high implied volatility is I prefer to wait until the end of the week. And in general, that actually seems to be the best way to trade these weeklies, because at all times your risk is always 100% with options. It doesn't matter if it's monthlies, if it's a year out option or whatever. All options have the potential to go to zero. And so the time when options are the most volatile and can gain the most value are the last 1 to 3 days till expiration. Are you going to lose, 50 to 70, maybe 100% of the value if you're wrong? Absolutely. But you can also make 100 to 500% just as easily. And so one 300% gain is going to cover you for 50% losses or 300% losses. In my opinion, trading options contracts that are within 1 to 3 days till expiration give you the best risk to reward ratio.